Welcome to Wall Street Sizing Up. We're glad you're here. Today, something very different. Aggressive ETFs. They can drive you to get liquored up and hit that skanky wallet, or Lambo money. Let's go. Again, thanks for joining the channel today. We're talking about aggressive ETFs. I think the first one might surprise you. First things first, did you know though, there are 2,000 ETFs in the market today. Of those, 200 plus are leveraged ETFs, and we'll get to those in a minute because they are very aggressive. I think this first one that I'm going to call aggressive, I think you might be surprised. If you look on the screen here, QQQ, you see it right there. What is QQQ? It's a very popular exchange-traded fund. It tracks the Nasdaq top 100 stocks. Here's the thing. Why is it aggressive? Well, it's certainly not the expense ratio. The expense ratio is only 0.2%. But here's the thing. Of the 130 billion investor assets that it holds, 63% of that is in technology. 21% of that is in consumer cyclicals. And 7% of that is in healthcare. Okay, that's 90%. Players. Here's where it gets even more aggressive. The Qs. The Qs. 10 stocks hold 56% of all the assets. 10 stocks. You've heard of them. FANG, FAMGA, whatever you want to call them. You'll see them here on the screen. There they are. Apple, Microsoft, Amazon, Facebook, Google, which is Alphabet, Class A and Class C shares, NVIDIA, Tesla, PayPal, and Netflix. That's very aggressive, especially on a day like this. I'm recording on a Friday. Not a very good Friday for tech. Tech is down. You can see the heat map right here. Almost 5%, if not more. Apple's down 2, Microsoft's 3, Amazon's 4, Facebook's down 4. So that's why when you go to the QQQ on today, it went down to 5%. It has now crawled itself back to being down just under 3%. I like this ETF. I like QQQ. It tracks a wide range of stocks, but they're concentrated. That's the thing. Again, before the last 2 days, for the week it was up 3%. For the month it was up 11%. 3 months it was up 26%. Great for the year. It's up 49%, and that's with a 38% downturn in March. And if we go to the 5-year, still just a phenomenally beautiful chart. It's like it's got an Instagram filter. You know what I mean? 166% return. That's great, right? But again, guys, I want to warn you, if the market turns down sharply, tech is the first affected because of the high valuations that we have. That being said, QQQ is a good tracker of technology and healthcare stocks on the Nasdaq. I like it, but again, it's very aggressive when you dig down into what it actually holds. When 10 stocks hold 56% of the entire ETF, that can get a little scary. Now, let's go to leveraged ETFs. That leads us to TQQQ. That is TQQQ is the ticker. Again, this provides 3 times the leverage exposure to modified market cap weighted index tracking the 100 largest firms listed on Nasdaq. Essentially, it's the QQQ, but with 3x leverage. You can see if the QQQ goes up 1%, the TQQ will go up 3%. And the inverse is actually true too. So it looks like QQQ is down 2%. This is down 7%. That's how a leveraged ETF works. Now, here's the thing. How do they leverage it up? Well, the 3x leverage is done through derivatives and debt, and that's how it delivers the leverage. The key here is this is just for day traders, or it's designed that way.
Well, who the hell else are you talking to? Talking to me? Well, I'm the only one here.
Because the expense ratio is way out of whack. It's almost 1%. It's extremely high, right? This rebalances. The TQQQ ETF rebalances every day. That means if one stock shoots up, 15%, the next day it goes right back to where it was, whatever that is, at 1.2%, right? So it will decay over time because of that and the fees, right? But here's the thing. With QQQ being so strong, you'll see on the screen, it was delivering at 38%. But here's the thing. Once you go to 54% the year, which I think the year was like 49% for QQQ, and the TQQQ is 127. And the 5-year is even greater. It was 166 for QQQ. For TQQQ, right, with a 3x leverage. Again, 3x leverage only for day traders, essentially. It's not showing that on this chart, right? You'll see that when we go to SQQQ, which is people shorting the technology stocks or shorting QQQ. You can see that it did 746% over the 166 of QQQ. So that's the 3x leverage, and that's what it does. But again, I cannot emphasize you. I know this chart is very deceptive. Wait till we get to another leveraged ETF, and you'll see what decay and the fees can actually do. It'll literally run a leveraged ETF into the ground. This is the only one that has done this, and that's because tech just continues to dominate and to go up in the past 5 years.
0. Ignition. Liftoff.
So let me show you that SQQ. So as opposed to TQQQ, we have SQQQ. So if you ever wanted to short technology stocks or the technology market, which is mostly what QQQ is, right, you would come to SQQQ, right? It's a 3x leveraged inverse ETF. And essentially what that means it attempts to reproduce the daily investment result that is roughly opposite the daily performance of the underlying QQQ index. Essentially, what that means to you is, and by the way, this one's got high fees too, it's only used for day trading.
I'll try it, you.
That's it, and you'll see why. So today, with the market, again, especially tech stocks being red, with SQQQ, when the tech stocks were down 5%, it was up 15%. Now that the tech stocks are down 2 or 3%, it's up 7%. And you can see that QQQ has done so well over the past month, 3 month, year, and even five years. You'll see that this is sliding, literally sliding into the Earth's core, right? Again, you would only use this for day trading if you thought that you wanted to short technology stocks, and that's what SQQ, very aggressive, right, with that 3x leverage, but one that day traders often use. I wanted to open your eyes to it. The next one I think you'll like as well. And finally, we come to my personal favorite, TECL. That is ticker symbol TECL. I have held this stock for about 3 or 4 years now. It's in my 401k. I don't touch it. It's just run. It's done very, very well for me. Let me tell you what it is. Direction Daily Technology Bull ETF. That's a 3x daily long leveraged technology select sector out of the S&P. Okay, for you guys, it is very short-term bullish. If you like technology,
I'm a cybernetic organism, living tissue over a metal endoskeleton,
and you like to be technology focused, which the economy has been for the past 4, 5, 6 years for sure, this may be your stock. Know this, the expense ratio is high. It's over 1%. It does rebalance daily, right? But here's where the aggression, the aggressiveness comes in. It's in the holdings. Like I said, it's the S&P technology stocks, but it's really 2 stocks. So out of the $1.86 billion market cap, 28% of that is in one stock, Apple. 23% of that is in a second stock, Microsoft. 50% of that 1.86 market cap for this ETF is in 2 stocks. So if you're bullish on technology and these big heavyweights like Apple and Microsoft, this is your guy, TECL. You can see it. Again, it trades with 3x leverage. For the month, it's up 9, and this is after the last 2 days just macro debacle. 3 months up 55. For the year, it's up 103. And for the 5 year, almost 1,000%. Literally, I believe it returns right about 65, 67% per year. That's what it's done for me. I wanted to bring this to your attention. Again, this is a very volatile stock. This is for if you're bullish, short term, day trading, or swing trading. That's what it's for. Again, it rebalances. So that means the fees and the rebalancing is going to get you at some point if technology takes a downturn. I don't see that coming. You probably don't either. But again, past results are not indicative of future results. So with that being said, I just wanted to bring TECL to your attention. It's a very aggressive stock. And I want to thank you guys. I know this was a little bit out of the norm. Instead of the 13D and 13G high conviction hedge fund buys, we went to aggressive ETFs. I want to thank you for sticking with me this long, because I really believe that this TECL ETF will absolutely pay off for you. Again, do your own homework. Please research this before you get into it. Very, very focused. With that said, guys, watch your six, go hard in the paint, and we'll see you.